Hello, my name is Joe Hoyle, and I'm one of the co-authors of your financial accounting textbook. I want to look today at the issuance and the financial reporting of bonds. Companies often need to raise rather large sums of money, maybe for operations and maybe for construction. So they have to know how to issue these bonds. We want to determine two things. One is, how do you determine what they will be sold for? And second, what is the financial reporting for these bonds after they've been issued? So here's the example we're going to look at. On January 1, year one, Ace Company decides that it needs to obtain some money and they're going to finance the construction of a warehouse. I tried to make this as normal as possible. This happens all the time. They create 1,000 bond contracts, and those 1,000 bond contracts are going to be sold to investors in order to raise the needed cash. Each bond has $1,000 face value, and they will come due in 8 years, and there are 0 coupon bonds. Now, that means this. It means that if we start right now and we wait 8 years, then in 8 years, each of these bonds is going to pay a face value of $1,000. That makes sense. That's how bonds are operated. However, because this is a 0 coupon bond, in the interim, no interest is paid at all. They don't pay interest on a 0 coupon bond. So if you're back here, the question is, how much do you pay for this bond? Well, what we're going to find out is that we're going to use present value techniques to determine what the investor will pay for the bond. And the way we will do that is we will mathematically remove the interest for that 8-year period of time. If you take the final payment of $1,000 and you remove the interest from that amount, then what you have left is the present value. And in this case, the present value is what the investor will pay for the bond. No interest is paid because it's a 0 coupon bonds. They agree that it will sell at a discount, and they have negotiated apparently an annual interest rate of 10%. So what they really want to earn in this period, even though there's no interest being paid, what they want to earn on this bond, what they've negotiated, what they've agreed upon, is that the bond will earn a 10% annual interest rate. Now, that will require us to make a mathematical computation to remove the interest and determine what that bond is worth. So let's see if we can work that problem. Here's the facts as we know them. The bond is $1 million worth of bonds. That's 1,000 bonds at a face value of $1,000 a piece. There's no interest being paid. It's an 8-year bond. It will come due in 8 years. And they will use present value techniques to determine the price. They will take the cash flows. They will mathematically remove the interest. What you have left is the amount that you should pay for the bond. The parties must negotiate the effective interest rate. So the two parties come together and the two parties decide upon what interest rate is a reasonable rate that they can both agree on. In this case, that's a 10% annual interest rate. And we take that as well as the number of time periods. In this problem, that's 8 years. So you have a 10% interest rate. You have 8 time periods. And then you look up the present value factor, and you can find that at the end of the textbook. You can find that in the internet. You can use a calculator. You can use an Excel spreadsheet. You can find the present value factor several different ways, and it will remove the interest at that negotiated rate, the 10% annual rate that the two parties have agreed on. And they will remove it for 8 time periods or 8 years. And what remains is the present value, the amount paid for the bond. If you look at that page, what I really want you to understand is this last sentence. When you find the present value, when you remove the interest because no time has yet passed, what remains is known as the present value. And in this particular instance, that present value is how much the investor should pay Ace to buy this bond contract and create this obligation. That happens in the world of business all the time because companies are always in need of rather large amounts of money. So we'll look up the present value of $1. We'll look that up for 8 time periods because it's 8 years before the bond comes due. And we'll look at it for an agreed upon effective rate of 10%. Notice the 3 things I focused on here. It's the present value of a single amount of $1 because there's only one payment. It comes due in 8 years, and the effective agreed upon rate is 10%. If you look that up in the back of the textbook or wherever you find your present value factors, you should find 0.46651. So the present value of these bonds, and remember, there's 1,000 bonds at a face value of $1,000. That's $1 million in bonds. So if you take that $1 million times the 0.46651, the buyer, the investor should pay $466,510. If I sell you a bond and you pay me $466,510, and we wait around for 8 years and I will pay you $1 million, then the difference in those two, the $466,510 that you give me and the $1 million that I give you, is going to be the mathematical equivalent of a 10% interest rate in 8 time periods. The difference between those is that annual interest rate of 10%, which was the rate agreed upon by the 2 parties. That's how the bond market works every single business day of the year. If you're going to be a business person, if you're going to be an investor, it's great. It's important to understand how a bond market works. ACE creates a bond, it takes it into the bond market. They determine the present value of those cash flows based upon a negotiated interest rate, and that's what the buyer will pay ACE for that bond. I thought it would be nice to make the journal entry. So on January 1, year 1, this of course is the entry for ACE because ACE is the one borrowing the money. ACE will receive $466,510. That was the present value. And therefore on that date, now it'll be different as time passes, but on that date, the bond payable is $466,510. You've made the computation now, and you've made the journal entry. What do we have left to do? What we have left to do, of course, is the recording of the interest. So here's what I always tell my students about the recording of interest in a zero coupon bond. Time passes. Every day there's a new day. Interest, and remember, we've talked about this before, that is the charge for using money over time. So as time passes, you need to recognize the appropriate amount of interest. During year 1, if you look just at year 1, the bond is reported in ACE's books at $466,510 because the negotiated rate was 10%. So what happens is if you simply look on ACE's books, you'll find the bond at $466,510. If you know the negotiated rate is 10%, and that's what they agreed upon, then ACE should recognize interest of $46,651. That is 10%. That's what they negotiated. That is 10%. So we will debit interest expense for $46,651. That's 10%. Now, this is a situation, a zero coupon bond, where the interest is not paid as you go along. So anytime you record interest, but you don't pay it, then it must be compounded. And if you remember from earlier chapters, compounding means you add it to the liability rather than paying it right now. So this bond payable is, or this interest on the bond payable is compounded because you have recognized the interest, but you won't pay that interest until the end of the 8 years when the bond comes due. To reiterate that, the interest is $46,651. It's not paid now. It's a zero coupon bond. It is paid, though, at the end of the 8 years because it's really part of the $1 million. So if you borrow $466,510 510, and then you wait 8 years and you repay $1 million, then somehow you have to increase this bond payable over the 8 years at the 10% interest rate. Because you're not paying it right now, it is compounded, it's added to the bond payable. By now, we've covered that term enough. I think you should know what compounding means. If you look on the balance sheet at the end of year one, the reported liability balance will be the original $466,510 plus the compound interest of $46,651. And that means the reported balance is moving toward $1 million. It's being compounded, so it's moving toward $1 million. And now it's all the way up to $513,161. In my classes, I always tell the students, if you can do 2 years of a bond or note payable, then you should know enough to be able to do any number of years. So almost invariably, when I work a problem like this in class, I will go on and recognize it for a second year just to make sure the students understand how things are done. In the second year, in year two, the bond payable has increased to $513,161. That's with the compound interest. The interest rate, of course, is still 10%. That's the rate that was removed when the bond was originally sold. If we take 10% of that $513,161, then the interest for that period is $51,316. Notice the process has not changed. The process is exactly the same. You get to the end of year two, you recognize that $51,316 as interest expense. It's a zero coupon bond. I am not going to pay the cash now. I will pay the cash interest when I pay the entire $1 million. If I don't pay the cash interest right now, I've got to compound it. You know what compounding means. It means that amount was added to the debt account, added to the bond payable at $51,316. The $51,316 interest expense is the number that you will find on the income statement. Because you've compounded the interest, the bond payable will move up again. At the beginning of year two, it was $513,161. You just compounded $51,316. You recognized it, but you didn't pay it. So therefore, the bond payable on the year two, or the end of year two balance sheet, is $564,477. If you follow this process, just like we've done for all of the years, at the very end of the 8th year, the bond payable T account balance should be exactly $1 million. And why is that? Well, when you computed the present value, you took the interest out at a 10% rate for 8 years. And then through the compounding, you put the interest back in at a 10% rate for 8 years. So if you're going to pay $1 million and you take out through present value interest of 10% per year for 8 years, and then as time passes, you put the interest back in, you're going to wind up at the same place. And that's at the $1 million figure in that case. As far as I'm concerned, this is a great introduction to bonds payable. And I always tell my students when we work a problem like this, if you can do 2 years of the zero coupon bond, then you're forming the foundation that will help you understand everything you need to know about the financial reporting of zero coupon bonds. Now, of course, we'll go on to more complicated bonds like a term bond, but this is the place to get used to that present value computation. My name is Joe Hoyle. I'm one of the co-authors of your financial accounting textbook. We're looking at one of the more interesting topics, and that's bonds payable, because we get to bring some of that present value computations into the financial accounting. Have a great day.